Well, it's a Thursday morning, and a very good morning to you from London. Of course, it's not morning in South Africa, and this will be the last time that I'm going to be talking to you from London. We're heading home at the end of April. It's going to be quite fun, Stu. Next time, we'll probably be doing this webinar from our Biznews premises, presumably in Rosebank.
Yes, Alex, very exciting news. Everyone back in SA for a bit. We get those good old meetings face to face again and hopefully come with some excellent ideas for future webinars, I think. But yeah, very exciting from a business point of view.
Yeah, and then of course, it is a little closer to the action on election time. We're going to be doing quite a lot of election coverage. So I think we're going to get ourselves pretty well jacked up for that one too. A very interesting election. Okay, but enough jibber jabber. We've got lots to talk about on our portfolios. And Stuart, do you want to just take us through the technicals?
Oh, excellent. Thanks, Alex. Yeah, if you can hear us loud and clear and see Alex's first page of his PowerPoint, can you just put your hands up to those you can see and hear? I just need to see some hands. There we go. I've got a few coming through. There we go. Excellent. We also like to keep it very conversational. So there's little questions drop-down menu on the right-hand control panel. I see I've already got one question there, but if you drop them in there, I'll pass them on to Alec as we run through the presentation, just to keep the conversation going nicely there. But thanks, Alec. Everything seems good to go.
Yeah, great. And we do have a PowerPoint presentation, so you see that on your screen, but I'll break away from the screen and take you into Wall Street Journal, our partners, where we have lots of data, so we can look to that as well. So really, let's just have a little fun for the next hour and kick off immediately, remembering that we've got two portfolios that are in the Easy Equities bundles, and you can invest in these. I think it's from as little as R5 if you want to, R5 a month. So they really have brought the investing opportunities to anybody by using fractional investing technology, and that is it's highly disruptive, very, very reasonable pricing structures, and really it's no longer, you no longer have to be a big institution to be investing in these big portfolios. You can do it as a private individual. We got two of them. The exponential portfolio. The mandate there is to invest in US listed companies with exponential growth potential. We've made a slight adjustment, as you'll see in the portfolio this time around. We're trying to get a little bit more ballast onto the portfolio itself. A little worried about, in particular, one of the stocks that was in the portfolio, Google or Alphabet, its holding company. There's a lot of wind coming towards, or headwinds coming towards Alphabet as a group, but particularly Google, and they've just picked up another fine in the European Union. It's all to do with privacy and the use of personal data, which is becoming a hot potato in the Western world, and we saw the impact on Facebook of that, and we're now expecting that there'll be a similar impact on Google. So took our profits there and put the money into deep value opportunities in the banking sector. Just a reminder, though, before we get into the portfolio itself, of why offshore investing makes sense. There's the South African rand. As you can see, fair amount of volatility. This is since the start of this portfolio, the US exponential portfolio. The rand, in fact, has weakened from around 1390 to 1460, where it is at the moment. That makes quite a big difference, as you'll see in a moment, to your return. But during this period, the rand was as strong as 1150. And it was as weak as 1550. So quite a volatile currency that we have to manage our lives with, our investments with in South Africa. So the best thing is to give yourself a hedge against the volatility of the currency. And that means offshore investing should be an important part of your portfolio. It could have been very different, though. The rand, in fact, could have blown out much worse had we not had Cyril Ramaphosa elected in December 2017 by the ANC elective conference. You can see there the initial parts of the graph, the very beginnings there, show how the rand and the Turkish lira were very much, very closely correlated. And then after Ramaphosa's election, they started to diverge. The black line is the rand, which underperformed the Turkish lira for a period of time, as you can see. But then from around May 2018, significantly outperformed the Turkish lira. Now, I use the Turkish lira because for many years these were closely correlated, and the guy who's running Turkey, Erdogan, is very similar to the guy who was running South Africa, Jacob Zuma. The Turkish lira has performed about 30%, underperformed the rand by about 30%. So the rand could have been 30% weaker, but the South African economy would have been massively affected had it been moved, had it gone in the same way as the Turkish have, because that difference of 30% has been achieved by a quadrupling in interest rates. In South Africa, the interest rate, the bank rate, is under 7%. In Turkey, it's 24%. Now, you can just imagine what would have happened had those interest rates had to be applied in South Africa. The impact on the private sector would have been dire, and economic prospects would have looked much worse. And that's really, when you think about what the Ramaphosa dividend has been for South Africa, it's not just in a rand that's 30% stronger than where it would have been. It's in interest rates, which are a quarter of the level that they would have been at. So think about that sometimes when you hear all the prophets of doom. The other part of this, of course, is the volatile US market. Now, for quite some time, in fact, since we started this portfolio in November 2017, the market was pretty steady in the US, as you can see. It traded, and we're using VOO here, which is the most closely index fund that most closely tracks the US S&P 500 index. And as you can see, that there wasn't really that much change from around $230, in fact $235, to a high of about $265. It's a very narrow band. And then suddenly, in September last year, the bottom started falling out of this market, and particularly in the area where we're most focused, which is on tech stocks, and the Vanguard S&P 500 index, or VOO as it's called, as its abbreviation is, went all the way down to below $220, which was a significant decline in the value of shares during that time. But the story with investing is, when all about you are losing their heads, just keep yours, and you can see that it has recovered, and even the tech stocks that are in our portfolio have recovered as well. But the overall market is only down slightly from where it was at the peak before that sell-off, and we once again have had a lesson that when others are running for the hills, that's the time, in fact, to be buying, or at the very least, not to be joining them. It's something that I feel about South Africa, and we'll get onto that in a little while. Moving on to what happened to the portfolio since the last webinar, we sold out of Alphabet. Now, just to dwell on this a little, I've been watching over the past 3 years at the World Economic Forum in Davos how the narrative has been growing against privacy, or the abuse of privacy, by, in particular, the Western world. We have Alphabet and Facebook. And effectively what they do is they give you a free service, and a very useful free service, but in return for that, they farm your data. So they get to know exactly what it is that you've been doing. And in this technological age, the big data can then get crunched and sold on, in the case of both of these companies, to advertisers. In other words, other people who want to reach you. And as you will see when you surf the web, it amazes you sometimes that you might have recently been on booking.com to have a look at a possible holiday in Mauritius, and you get bombarded by adverts from hotels in Mauritius. Now, the only reason for that is that somebody somewhere knows exactly what it is that you've been looking at. And it could be through your emails, it could be through emails that you send to people, it could be through your surfing on the web, it could be through what you were doing on Facebook and talking to people about on Facebook. All of this data, all of this information, when you're using these products, you tend to tick the right boxes, and that information then gets crunched by Facebook and Google in particular. And through this, they have scooped up 68% of online advertising in the Western world. That's why the media industry is in such dire straits globally, but also because the way why they've been able to do this is because the media industry just cannot compete with the granularity of information that Google and Facebook are able to offer to advertisers, potential advertisers. If you want to reach, for instance, somebody who would like to, let's just say you've got a whole lot of prints of Stubbs's wonderful whistle top. I'm trying to think of something a little arcane, but his painting of Whistletop, which is a beautiful horse that appears in the National Gallery in London, and you've got a whole lot of these prints. Well, if you go onto Google, use Google or Facebook, you'll be able to find people who've actually looked at or target people who've actually gone to the National Gallery website, or who might have been talking about Stubbs in their correspondence with others. Pretty scary stuff. But of course, you'd be prepared to pay more money as an advertiser to reach those people, and there's no other publication or no other vehicle as an advertiser that you'd be able to use to get to them. The scary stuff is when you're on the other end of the adverts that are coming to you, and this is where the feedback and the kickback is coming. Now, in China, it's quite interesting. In China, they don't have these issues or concerns about third-party data, and that's where Tencent, which is important in a South African context, given Naspers' relationship, and Alibaba, which is in our portfolio, come into it. Because in China, from the beginning, there was an agreement between the government and the tech companies that they will not sell data on their users to third parties. Whereas in the Western world, both Facebook and Google have their entire business models are based on the sale of data to third parties. So it's quite interesting. There's often China is banged over the head for being less aware of human rights, but in this case, the companies in China, you don't have to worry that they're going to be hit with the same hammer that is likely and is happening now to Facebook and to Google. And we're seeing both of those companies come under increased pressure as lawmakers understand more about the relevance of data being used by them and the whole privacy issue. Anyway, so put all of that together. My view was that we've had a fantastic run with Google stroke Alphabet. As you can see, we bought the shares at $10.91. Sorry, at $980. We sold them at $10.91, and we banked a nice little profit there. In our global portfolio, which we started 5 years ago, we also sold them out there, and that one we more than doubled our return on Alphabet. I don't believe in selling shares. I believe that you buy shares to hold forever, but the reason why we sold this stock was because it now doesn't make sense anymore, given the fundamental shift in the business model. Alphabet stroke Google has tried to find lots of other ways to earn money. They've got driverless cars. They've got lots of bets in different areas. But the only area where they make money, and they make the majority of it, is from advertising. And so hence the whole privacy story is a big one there. So what did we do with that money? Well, we as mentioned right in the outset, we're trying to get more ballast in this portfolio. We're trying to get a little bit more stability in it. And if you have a look as a value investor over a long period of time, you'll discover that the banking stocks are offering enormous value. In fact, JP Morgan Chase was one of the biggest buyers of its own shares in the past year in the United States. The share buybacks, incidentally, last year in 2018, were up by 63% to a record of, get this, $223 billion US. Extraordinary how much money companies in the United States have used to buy back their own shares rather than investing in productive capacity. This also was a consequence of the tax cuts. When Donald Trump cut taxes in the US, he was hoping that US companies, or anticipating that US companies, would use the benefits of that to invest in productive capacity. In fact, what a lot of them have been doing is actually just buying more of their own shares back, which of course gives you a nice fundamental base to those stocks, and quite a few of them in our portfolio. Apple bought back last year $74 billion of shares. Microsoft bought back $16 billion. And JP Morgan bought back $20 billion of its own shares. Of course, it's got a much lower market capitalization than the other two. So JP Morgan, the people at JP Morgan, and it's run by Jamie Dimon, one of the smartest bankers, acknowledged to be there on the planet. They've decided that their shares are really cheap at the current level, and so they've been buying them back. Morgan Stanley is the other one that we have in the portfolio. JP Morgan actually was doing quite well until just a couple of days ago, when there was a little sell-off in the stocks there on the concerns that the United States recovery wasn't going to go as strongly as anticipated. But there you have it. It's typical hog style, buying in far too early, and both of those shares are down slightly. My recommendation always is that when you're going to buy into a new stock, stagger the purchase over 3 months. Of course, in this portfolio, we can't do it that way. But as you can see, from when we bought in on the 29th of January, Morgan Stanley's down 2.5% and JP Morgan's down 4.5%. Nothing to worry about, of course, at all at this stage. Just moving on to the portfolio as it now stands, it has been a fantastic performer. You can't expect that it's going to continue like this. And we have Amazon to thank, up 72% since we bought in November 2017. But I think the bottom line is in green at the bottom there. It says in Rand terms, the portfolio has grown at 25% annualized. It's up 33% actual, 25% annualized in Rand terms. The Rand has gone from 13.90 to 14.60 over this period. So you convert your Rands into dollars, $100,000 in this case, and you would have taken the value of this portfolio from about 1.4 million Rand to 1.85 million Rand now. Thank you, Amazon. Thank you also to Microsoft, which has been a phenomenal performer. Those of you who've been following the portfolio since the beginning, the reason why we like Microsoft, or why we injected it into this portfolio from the outset, was that they had changed their business model from one which is now annuity income. So the whole subscription model, annuity income, is really catching on now in the United States. And it's interesting to see that Apple, in its big announcement last week of its change in strategy, in fact, last week is this week, big change in strategy, is now focusing more and more and more on annuity income, on services income. So Apple was a company that people used to buy on the performance of the cell phone, on the mobiles. In other words, how many iPhones were they selling? Now the message, the penny is dropping, that actually Apple is not an iPhone company, it's a services company. Again, those of you who've been following this portfolio for a long time will know that that's a drum we've been banging quite strongly here, on the view that there are 1 billion devices that Apple has in various hands, and now it's looking to use those devices, or to integrate the software, if you like, the opportunities on those devices into its massive audience. And the announcement this week said they're moving very aggressively now into television, but also into media. So they're going to be offering news for $9.99 a month. You can get to 300 different news providers, which many of them at the moment are behind a paywall. Included there's the Wall Street Journal, which is quite interesting from our perspective. And we're not sure how much of the Wall Street Journal will be put there, because clearly the Wall Street Journal is not going to give away all its content for $9.99 when it sells it at $28 direct subscriptions. But there is there's some kind of a business model that's been worked there, that I guess they're going to offer some of the Wall Street Journal content to the Apple back end, and 299 other publications in there. But that's what Apple's about. Apple's now about subscription model. And if you look at what happened with Microsoft when investors started clicking to that reality, you have a possibility of what could be happening with Apple with a re-rating there. Interestingly enough, the last time we had this webinar, we missed out on the December quarter, but it was in the after the third quarter of last year, late August. And there, since then, the market as a whole has dropped quite significantly in the United States, especially in the tech stocks. But as you saw earlier, if you'd held on and keep holding on, we've been able to ride through that market. But it is interesting that of all the stocks in this portfolio, both Adobe, which was up from 250 in August. In other words, before the tech crash or the tech sell-off. It's now 262. So that's interesting because Adobe is the antithesis, if you like, of Facebook and Google. So again, the argument there is that as Facebook and Google come under more pressure, Adobe will benefit more. Reason for that is that Adobe provides Facebook stroke Google type tech to media companies who are competing with them in the advertising space, as well as the PDFs, the ubiquitous PDF that comes from Adobe, and other products that Adobe has in software products. It's a very, very good company, and one I thoroughly believe we should have in the portfolio, obviously, because it's there. But Microsoft is the other one. So despite getting to a very high point ahead of the meltdown in the tech sector, it's actually put in another nearly $10 a share since then as this penny drops. That's the real way to make money in the future is subscription revenues. Amazon has done okay. It's down from $18.96. In fact, got to $2,000 at one point, to $17.65. Came all the way down to much lower than that, and we'll look at that in a moment. And Alphabet's out of our portfolio. That's down from $12.35 to $11.73. Apple, on the other hand, went a lot lower, but it's perking up now as the story gets through. So I hope all of this makes a lot of sense. Stu, I'm not sure if you want to pick up immediately with any of the questions.
Thanks, Alec. There's just one, but it's not on the portfolio. It's more on the platform we use, Easy Equities. Michael wants to know how secure is it given Purple Group is loss-making and burning cash? I'm not sure you've got the insight on that.
Yeah, I mean, I'm not a director of Purple Group, but like most people, I can read the SENS announcements. And Purple Group is now got a strong relationship with Sanlam, and Sanlam invests in highly innovative opportunities, and they put a lot of money, a lot of cash into Purple. So, and I know the guys from Purple, they're not morons. They have made a big bet on bringing out or democratizing share ownership, and they've got literally hundreds of thousands, I think, now of people who are on the platform who are investing in shares through Easy Equities. One of the and of course, while you're building up this base, you will be investing cash, and it's one of the stories that South Africans kind of don't get yet. And it's interesting. I've often felt we should be putting Purple into our SA Champions portfolio because it's a model that is extremely well understood in the United States, where you are going for market share and where you're going for exponential growth. First, you have to invest. In South Africa, when companies are doing that, and I remember it from the early days of MoneyWeb, when we were investing heavily in building a presence in the internet space, investors kind of couldn't get it. They wanted us to be making profits. And my argument always was, but you know, Amazon, and we see it today, Amazon didn't make profits for decades, literally. Same thing with Google. They took a long, long time to make profits. And when they do make profits, they can then transform or turn that exponential growth into strong bottom line increases, because you only have to put a little bit of extra margin when you've got a huge base. And the Chinese have shown us this throughout in the way that they approach the business model. But if we go back to Purple itself, they do have Sanlam as a substantial shareholder. Sanlam gets the exponential growth model. Purple is growing. The time that you need to worry about Purple, I would say, is when their growth starts petering out, or when they start having to, or should they ever have to start contracting, because at that point in time, you would be a little worried that they couldn't fund it into the future. But I don't see that happening anytime soon. They got enough cash in the bank thanks to the Sanlam relationship. Hope that helps.
Excellent, thanks, Alec. I think the other questions are all around Naspers, but I'm sure we'll get into that in a bit.
Yeah, for sure. Okay, so let's have a look at this. You can see Amazon has been our big winner. We're expecting big things from Apple because in the same way as Amazon's business model was not fully understood and is now well, now it's well understood, and it's kind of old news that Amazon is going to just continue to bulldoze its way to greater growth. And one day, when they want to switch on the taps, they will be able to do that. The profit taps. It's quite interesting. Earlier this month, the last analyst on Wall Street who'd been hanging out against Amazon rather, who'd been saying that Amazon was a sell, has actually just converted. So you have 100% of Wall Street now who have Amazon, or certainly of the analysts, the serious analysts that are polled, they have Amazon as a buy. The last guy was from KeyBank, if you want to go and look it up. Now he says that he's redone his numbers, and actually Amazon is at a position where even a slight increase in their profit margins is going to make a huge impact on the bottom line because of the scale that they've grown to. Just on Amazon, before we move off, you'll be very interested to go and have a look on Biznews that a South African company made the Amazon radar. Standard Bank have just moved their whole back end onto Amazon Web Services, which is something that Amazon started 13 years ago. The rest of the marketplace only got into this 7 years ago. So the visionary that Jeff Bezos has translated into just some massive business advantages, including the cloud, which of course is what everybody's talking about now. And you might also find it interesting that one of the early pioneers of the cloud was a guy called Paul Maritz. And as you'd know from the surname, yes, he is South African. He was one of the top guys at Microsoft, and one of Bill Gates' right hands. And then when Gates left, Maritz left as well, and he went into cloud computing long before anybody else or was getting excited about it, in a company called VMware. Unfortunately, we didn't buy that when it was cheap, but it is interesting to have that South African connection always coming up, it seems. Okay, so there's the portfolio star, as you can see quite clearly. Amazon, these are the stocks that we've held for a little while. And the one that isn't doing so well is Alibaba. I'm not worried about that. Right, there's Jeff Bezos, as he has given us such a lovely return. We should honor him, I guess, with a nice picture. And the Amazon effect, there it is, of the share price. Now, I wanted to just add this. I haven't got too many share prices to add, but if you can see from October, when you had the September, you had the meltdown in the tech stocks. Amazon took a little longer, and then in October, early October, it started falling, and it went down, as you can see, from $2,000 down to about $1,300. That, of course, would have been the right time to have bought in. And as you see the volumes down the bottom, there were some quite nice purchases at that stage. It's recovered all the way to over 1750 now. So sometimes you just got to keep the faith. All right. SA Champions portfolio. The mandate here, JSE listed companies driven by South Africa's best entrepreneurs. Naspers entrepreneurs, come on, of course you know it is an entrepreneurial operation. And if you just look at the way that they have done the deal this last week, and we'll spend some time on that in a moment, you do know that this is a company that is, well, I think it's still got a long, long way to go before we need to worry about it. In the South African stock market, some life at last. Interesting to see here. It could well have bottomed in November. It looks like it. If you look at this graph, you see November 2018, the all-share index getting to 7,000. Then it's, sorry, this is not the all-share index, the financial and industrial index. That's the index that we use, financial and industrial index, because if you start putting in the all-share index, you bring in commodities, and commodities are so hard to catch right. I believe that investing in South Africa, well, first of all, you've got to say to yourself, am I investing in commodities or in human ingenuity? I go with human ingenuity. So you pull commodities out. Then you have a look at the nicely named index there, ALEX, the Industrial and Financial Index. And you can see there that it bounced around a little bit, bottomed out there in November, carried on through early January. And now it's starting to give the kind of technical signals that technical analysts would be excited about. if we have an election which has an ANC, a strong ANC majority, in other words, a good mandate for Cyril Ramaphosa, you can anticipate that moving average line will be decisively broken, and then you get all kinds of analysts or technical analysts getting very excited about it again. But at the moment, I have been arguing that South African shares are cheap, and this is a graph which would tend to suggest it. However, our portfolio is underperforming, and we took a big knock through Wilson Bailey, WBHO, and it took a big knock through a contract in Australia. Now, I'll talk about that in a little more detail in a moment, but just to really encapsulate it, fortunately, when you have a diversified portfolio, as we do in this case, you do not get too badly hurt when you have really bad performers. And Wilson Bailey really got hit. As you can see, it's down by 34%. So should we be selling? Well, at 108 Rand a share, down from 164 that we bought at, there will be some people who'd say that, take your losses and move on. But it really looks to me like it was a one-off event. It is in part of the world where they have great expertise. In fact, more than half of Wilson Bailey's revenues are generated in Australia. What happened here was that there was a misinterpretation between the Aussie company of Wilson Bailey and the municipality of Melbourne. It's to do with widening and expanding of the road network within Melbourne. Somewhere along the line, somebody made the wrong calculations, and they've had to put 50 million Aussie dollars aside. They have to do more work on these roads than they anticipated. And Wilson Bailey generates profits of only under 5% profits on the revenues that it generates. So you get something wrong like this, you really do get punished for it. And they had a negative margin of 4% in Australia. They've taken the knock up front in the interim results, which were released this week. It did see their operating profit collapse by 99%, but at least there was a small operating profit. They didn't move into losses. But at the same time, the revenues were up 11%. So there's a huge rebound potential here. Even at their normal profit margins of 4%, you can see this company, once the Aussie issue or the Aussie problem is moved out, you can see them, you can see the share price really rebounding. Investors are nervous though. They've taken one hit. Often what happens in a bear market, as South Africa is in at the moment, people just lose confidence. But Wilson Bailey is an interesting business in that around 20 billion in the 6 months turnover, 10 billion, nearly 11 billion of that came from Australia, where they had the problem, and they only had the problem in one part of Australia as well, one contract. And the UK is 2.5 billion in Rand terms, that is. So if you look at that, it's 65% now, sorry, 65% now of the income that is generated from Wilson Bailey is outside of Africa. And Africa itself is quite a nice contributor. The rest of Africa, 69 million Rand in operating profit during this period. South Africa, 273 million Rand. Of course, there was a 445 million Rand loss coming out of Australia with that 50 million Aussie dollar setback. So we won't be selling Wilson Bailey. Long for Life, that's Brian Joffe's company. And it has been a disappointing performer, as you can see, down 21%. But again, we buy stocks forever. Joffe is a masterful entrepreneur, and the stock is not traded that heavily. So when he does get his pieces in place and things start moving for Long for Life, you can anticipate that those shares could move pretty smartly. At R4.48, there is a discount of 52 cents on those who supported Joffe right from the outset. In other words, the big institutional investors have put 2 billion Rand at his disposal through equity capital. They are losing 50 cents a share. We're losing a little more than that, but I'm quite happy that we stick with it. Naspers, maybe let's get on to the mighty Naspers, because that is a share that is, as you can see in the portfolio, it's 29% of our portfolio, nearly a third. And we've been criticized for having such a heavy weighting there. But as Warren Buffett says, if you are going to invest, be smart, put most of your eggs in the basket, put your eggs into one basket, but watch that basket very carefully. And Naspers is still trading at a 40% discount to its 10-cent shareholding. Now you can see there, I put at the bottom that red chart, and this comes from the Wall Street Journal. That's the money flow index, very nice index, that one of many that you can use on the Wall Street Journal's database. And as you can see there, from around November last year, this has been moving steadily upwards. What that tells us is that the demand for the stock, there's nice money that comes in. It's steady. It's almost smart money. This is smart money when you look at it when you see a share performing like this. It's moving in the right direction, but it isn't surging up as you would find when the dumb money chases particular shares. You can see on this one that it's moving up really nicely. And this is the kind of performance that will hearten any long-term investor and certainly make any serious portfolio very, very happy. So Naspers has done well. What has happened in the last week has been confirmation. You can be sure the smart money was doing its own estimations of what was coming. We did have the unbundling of multi-choice. I haven't worked that into the portfolio. It's got to be there somewhere, but I just haven't had a chance to unpack that. But certainly we've got a bit of a booster into the portfolio from the multi-choice shares that we received from Naspers. I see Easy Equities need to just put that through as well, but we'll have that conversation in the next couple of days. But what you can see is that was a significant boost, about $3 or $4 billion US. Not that great in a huge portfolio like Naspers has got, but the big move was in this past week, where they now have permission from the South African Reserve Bank, they have permission from the JSE to take all those offshore assets, and primary of those is $135 billion worth of 10-cent shares, and to list those separately in Amsterdam. So now, if you're a global investor, you don't have the problem anymore of having to buy through the Johannesburg Stock Exchange and perceived risk of exchange control. You'll be able to go straight into these stocks, and Naspers really is a proxy for 10-cent. It's got lots of other assets in there as well, mail.ru. It's huge international classified business but the Naspers stock, for most global investors, is still perceived as a proxy for 10-cent. And if you want to buy 10-cent shares through Hong Kong's market or at a 40% discount through Amsterdam, it's a no-brainer what you're going to do. So that 40% discount, in my estimation, is going to start contracting to perhaps a 20% discount, which gives you a very, very firm undertone for Naspers. I hope that answers a lot of the questions in anticipation. But Stu, let's hit them.
Excellent, thanks, Alec. Andre just wants to know if SA Champs will take up the Nuco shares with the Naspers changes.
Definitely. Nuco is going to be it's going to be an entry point now for foreign investors, for international investors who know about Naspers. So this is the thing. When you, as I have lived here for 3 years in the UK, when you live in the international environment, there are very few South African companies that register. Discovery registers. Vitality is a very, very powerful player in the UK market. Investec registers. It's very hard to not see Investec when you're around London. Do that next time you're in the city. And Naspers on a global scale registers. Naspers is a player. It's a real player. And this transaction is going to make it the biggest European internet listing by quite some distance. So if you're investing just in internet stocks, you are obviously going with Silicon Valley, but you like to look for stuff outside of Silicon Valley. So you'll go with Tencent and Alibaba, perhaps from China. And what do you go with from Europe? Nothing at the moment. This is one that they will be going into. I did ask Bob van Dijk, and as premium subscribers, you can go into the back end and go and read that interview. It was fascinating. But Bob was, when I asked him, what does he expect the impact will be from the listing in Amsterdam, just from the index funds. He said there would be a $2 billion flow of funds which they had to put in. Now that immediately brings demand of $2 billion, which means clearly it's going to help to lift the share price as well. So all around, the new listing or new co or whatever they decide, and that must be occupying quite a few minds what to call it, will be the kind of stock you can trade it in South Africa as a secondary listing as well. And that's of course part of this SA Champions portfolio. We're only investing in stocks that are traded on the South African stock markets, either A2X or on the JSE. And this is the new co will be there as well. So most definitely we will hold on to that.
Thanks, Alec. I've just posted those 2 links from Bob van Dijk and Standard Bank when you want to take a look. Got another question here from Andre, but it's not on Naspers, unfortunately. It's on the Ashburton midcap. He says, what's your thinking as an active manager taking a fairly large stake in a passive like the Ashburton ETF? He says the ETF passive fans will surely criticize us and say we should just go passive.
Yeah, Andre, I'm not a portfolio manager, so I'll stop right there. The idea that these portfolios are bundles. I'm not taking your money and investing the money on your behalf. What I'm doing is I'm putting my own money into these and also using the experience that I have from studying these markets every day, and of course Warren Buffett's philosophies. But so essentially what we're trying to do, and that's exactly what we're doing with the US portfolio as well, is to try and get a bit of ballast. When you're nervous about the potential for a particular asset class, then you need to be more conservative. When you see the way that exponential stocks have outperformed over such an extended period, they're not all in the same category. There's very good reasons to be in Microsoft, Apple, Amazon, Adobe. Not so many good reasons to stay in Google or Alphabet stock anymore. There's a deep value opportunity in US banks. That's why we selected those 2 banks, or to give us a little bit of a spread rather than one. In the South African context, the mid caps are very difficult to pick. They are thinly traded, so if you buy them at the wrong time, you can in fact push the price against yourself, or when you sell them at the wrong time, you could be pushing the price against yourself as well. So that's from the one perspective what I'm a little bit nervous about. I love, for instance, Italtal, the whole Ragazzotti group. This is a phenomenal entrepreneur, but my goodness, to try and buy the shares in a large sense, and we've got like hundreds of people now who are following these portfolios, not just buying the bundles, but doing it directly. You really don't want to put yourself at a disadvantage. There are also other mid-cap shares that are just too difficult at the moment to identify and to pick out. So that was a bet, if you like, or an investment on Ramaphoria. And the stock, as you see, has not done that great. It did a little better in this last period. There we go. I just want to give you the portfolio. Oopsie, wrong one. There it is again. As you can see, the Ashburton midcap is about 16% of the portfolio, but it's a chunk of the market. And I believe that as South African investors, or if you're positive on South Africa, and I'm even more positive today than when Ramaphosa was elected, you need to have that side of the market invested in it. And on this one, on the Ashburton midcap, what has been interesting is that as we've kind of lifted off the November, December, early January bottoms, this one's also risen. If you can remember from August last year, we were at 7 Rand, or its ETF was at 7 Rand, it's now 7.24. Okay, no big deal, but it's a nice bit of ballast, and it is something as well that is a good one for the future. So 2 things there. I'm not an active manager. All I'm doing is saying to you that from my experience, you should have a small portfolio. This is the portfolio where my money is, and it's easy enough if you just want to invest if you want to invest 10 or 100 or 500 or 5,000 Rand a month, this is an easy way to do it through the easy equities fractional options. And when you go onto the bundle, you don't have to buy all the shares. You don't have to go with all the shares. You can only take some of them if you want to. So I think that really puts this into perspective. I haven't given up media to become a money manager, no.
Excellent, thanks, Alec. David Melville's got a question on share buybacks. He says, I think it's more on the US portfolio, Alec, with share buybacks by the two financial companies, is this not tantamount to keeping the share price up? Yeah. I wonder what the share price would be if the companies were not buying back their shares.
Yeah, it's a very good point, and that's exactly what it does. Because as you get more demand for the stock, and Apple is a very good example of it, then you're an extra buyer that comes into the market. I mean, as I mentioned a moment ago, with Naspers, the index funds alone will have to invest $2 billion into Naspers when it lists the offshore operations in Amsterdam. But something on this side, and Warren Buffett makes a very, very good argument for this. He says that he loves to buy companies that buy back their own shares, because what it does is it increases his proportionate stake in the company when they do that. And it's easy to understand. If you had, say, 100 shares in a company, for argument's sake, and you go out there and you buy 10 of them back, that means in the past you had 1/100th or 1% of the business. Now you have 1/90th, or what's that? Well, a little bit more than 1% of 1/90th. I'm not going to try and do the calculations in my head, but okay, as you can hear, it's 1.1%. You own 1.1% of the business from 1% before. Of course, the maths guys are probably laughing at me and thinking, why can't you do that in your head? But that is what it's all about. If you trust the management team and they say, our business is so cheap on the market at the moment that we should be buying back our own stock rather than investing it into more productive capacity, then you've got to trust them. And I'll give you my own example. When I was running MoneyWeb, we listed in 1999 at a rand a share, and there were more asset managers who wanted shares than we ever were able to allocate to them. In fact, such was the excitement about the internet at that time that the merchant bank who did the listing for us did it for free. We didn't pay a cent for the listing because they said, well, all we want is a proportion of your shares that we can then offer to our clients to butter them up, if you like, because we'll get more business from them in that way. It didn't matter to me. All we were looking at was raising money. The share price on day one went over, it doubled to over 2 Rand a share. And then not too long after that, the bubble burst, the internet bubble burst. And we found the stock trading within a year at 19 cents. Seriously, went from 2 Rand to 19 cents. We had the same amount of money in the bank. We had the same, in fact, we were a bigger business, a more exciting, and our business was growing more rapidly than we thought. Yet the shares were 19 cents. What did I do? I went and bought back shares for the company and did that quite often during the period of MoneyWeb's life. I remember another example was when we bought Classic FM, which was bankrupt and in big trouble. They were about to go under, and we saw this as an opportunity to expand our business. We did a deal with Liberty, who had invested or had lent a lot of money to Classic FM, and we converted their debt into equity. We placed shares with them at a rand a share. And I remember buying back those shares from Liberty or in the marketplace at under 50 cents later. So it is just the way it happens. If you are within a company and you know the company better than other people know the company, because you should, when Mr. Market gets into his crazy attitudes, remember, when you read Benjamin Graham's book, The Intelligent Investor, one of the chapters will explain in great detail how you should be taking advantage of the market, of Mr. Market, of his moods. He's a manic depressive. Benjamin Graham wrote the book in the 30s, 30s. There were no, at that time, there was no medication. So imagine this manic depressive who one day wakes up and the sun is shining and he's all happy and he's prepared to pay 200 for something, and the next day there's clouds and he wakes up and he's feeling depressed and he's prepared to sell at 50. And that's what Mr. Market's all about. We see this, we see examples of this all the time. And as an investor, what Buffett tells us is your greatest challenge is to get control of your emotions. And I think that it's almost like, as a South African, that's our greatest challenge as well. Just get control of your emotions. Just get out of this fog, this funk, where everybody and the noise and the headlines and the shouting and the emotions and the agitation, because actually life is never at the extremes that some people sensationalize it to.
Thanks, Alec. Niels has got a question on Investec. He says, with very conservative growth and discount rate assumptions, it remains undervalued. Is it just the Brexit SA story, or is there something else?
Niels, I tell you, this one, it just I scratch my head about Investec and have to come to the conclusion that it's one of those sleepers that, when we bought Amazon, interesting point. We bought Amazon in the global portfolio, $327 a share. And at the time, I could not believe that it was falling. The share price continued to fall. And it was because our view on Amazon was different to the view of the marketplace. Right back then, there was some noise that was going on that it hit back the Amazon. I think they delivered a loss which was greater than had been anticipated. And when you look at Amazon, that's got nothing to do with the business, what the profit and loss was, certainly not 5 years ago. And I feel the same about Investec. It's one of those companies that if you just walk into the organization, they hire the smartest people. They have fantastic branding. They are continuously earning market share, both in South Africa and in the UK. Just try, if you aren't an Investec, or if you are an Investec client, you'll know what I'm talking about. But just try and phone their call center, for instance, and you will be knocked over, bowled over, because instead of people who battle to get a job anywhere else, at Investec, they only have graduates in their call center. So you have that impact, that immediate impact of a high quality, very carefully selected person who works in the organization. There might be an argument which says Stephen Kossef and Bernard Cantor have been there for 40 years, and it's maybe time that they should move on, and perhaps they haven't, they aren't sexy enough for the market. I feel completely differently. I believe that the institutional memory that Investec is going to lose when the two of them move on is significant. However, they're going to stay on the board, so they won't be gone forever, and they're big shareholders, although I think they have been lightening their stake recently. But in Fani TT, who's one of the smartest people I've ever met, and Hendrik de Tooy, who is definitely one of the smartest people I've ever met, you've got two incredibly good business brains who are taking over, the one running South Africa, the other one running the UK. And they're going to be splitting up the operation into asset management and banking in due course. Maybe the market's waiting for that. But my sense of Investec is it's one of those, just ignore the share price. It's like Apple. When we bought into Apple in the other portfolio, I remember we paid $110 for the shares. Sorry, it was more, $130 for the shares. They promptly went down to 90 and looked like they were going to go much lower. And you start wondering, have you got this wrong? Has Mr. Market outfoxed you? But investing is all about what mentioned earlier from Buffett. Just try to keep your head. Get away from the emotions. Do your homework. Understand what it is that you're investing in. If there's a fundamental change in the reason why you made that investment, and it does happen from time to time. We've had that over the years with, well, here we've had it with Google. There's a fundamental change in the way that one looks at Google into the future because of the privacy issues. Then you need to act. But until then, your holding period of a stock is forever. And I think with Investec, that's probably the best approach to take. Just forget about it.
Excellent, thanks, Alec. I think just there's a final question from Benjamin. He looks for a view on commodities, but with reference to electric vehicles. So, with regards to platinum, palladium, and rhodium. I'm not sure if you have any say on that.
Yeah, that's a very good question. Electric vehicles, I saw some stats this week. Actually, I went to a presentation in London with the head of research of Investec. What an impressive guy! Wow. But he was doing some extrapolations on electric vehicles and the investments that China is going to be making in it. And it is definitely an industry to be doing your investing in now. The big one is, of course, cobalt. And probably the best play on electric vehicles is BHP Billiton, which has got big stakes in. And in fact, Ivan Glasenberg has focused his BHP Billiton, my apologies, Glencore, not BHP Billiton, scratch BHP Billiton. Ivan Glasenberg from Glencore has structured his portfolio, he did so a few years ago, where he continually refines it for electric vehicles. So there could be a more direct way. I would not, however, recommend Tesla. It's just too volatile. We've been shareholders of Tesla over the years. We're thankful to get out in the 300s. I see it's now 260. One just doesn't know. As much as you have to admire the intellect of Elon Musk and his entrepreneurial spirit, you've got to worry about the volatility in his character. But there are other options. We see Volkswagen is going quite aggressively into electric vehicles. Once you're sure that the diesel issue is gone, then it's a time to look at that. Palladium is benefiting because of not necessarily with electric vehicles, but because of the switch from diesel to petrol. You might remember at one point in time, there was this drive in Europe to have auto catalysts for diesel vehicles, and that's where palladium is used in petrol. That's where platinum is used. So platinum is used for the autocats in diesels. Now that diesel's fallen off the table because of what happened at Volkswagen, the shift has gone towards palladium, and hence palladium's share price has gone crazy. But if you want to have a bet on electric vehicles, you're probably well positioned at the moment with Glencore, but I worry about Glencore and what they've been doing in the DRC and all the stuff that's coming out there as well. Particularly now there's a new president there, new global attention, etc. So it might be a bit early to be placing your bets there. There've got to be other options. BYD in Hong Kong, that's a possibility. Go and do your homework on that one. They make batteries and also very focused on electric vehicles. But I think we all need to do our work there and maybe share some insights once we've found something that is really well positioned.
Excellent, thanks, Alec. I think that's the hour up, and thanks for your time as always. Excellent insight.
Well, I'm pleased that we managed to get everything through, and I really appreciate the questions as always and the support for Biznews. We didn't get a chance to actually go through the Wall Street Journal, which I wanted to take you through a few things, but we'll do that on another date. Thanks for being with us today. Until the next time, ciao.